Well, slowing growth, increasing offshore, increased offshoring and ramp up in cloud technology. Well, that best describes the state of the Australian IT and telco sectors, according to BBY TMT Analyst Mark McDonnell.
Well, Mark reckons that we're essentially now seeing, if anything, a rapid convergence between the two sectors. Some big-name players might not be around for much longer.
Well, as you can tell, Carson and I are not quite that adverse to this topic. So, Sky News tech reporter Nigel Freitas, our tech guru down in Melbourne, speaks to Mark for us now.
Good afternoon, Moira and Carson, and also Mark, thank you very much for joining us on Sky Business today. Now, you've done some analysis, some interesting analysis of the IT sector. You say in FY12, revenue growth up about 8.8%, and you've called that subdued growth, Mark. Is the IT sector in the wrong lane of the two-speed economy?
Oh, not at all. It's subdued relative to the companies that contributed that 8.8%, Nigel. I mean, what we're looking at here are the ASX-listed companies, not the entirety of the IT sector, which, as you know, embraces a lot of very big multinational companies like Capgemini and Accenture, Fujitsu, Tata, Infosys and so on, IBM of course, or a lot of little unlisted companies either. But just looking at the core stocks in Australia, there are half a dozen that I've noted in the speech that I gave today. They had 8.8%. Look, that is better than double GDP growth last year. It was 3.7% in nominal terms last year. Relative to the two-speed economy, it's actually in the medium-speed lane. The point about it being subdued is that these same companies, only 4 to 5 years ago, were reporting 30, 40 and 50% growth. So it's a big change for them and a big change for their relative growth outlook.
And why is that, Mark? Is that because of the general economic conditions, or are they just not performing up where they should be?
Well, it's partly the general economic conditions. So if you take a company like Data3, for example, that actually had the best top-line growth of the 6 companies, 16% reported last month. In fact, its earnings went down by about 9%. And it did that because a lot of the more lucrative business that it does, which is in the area of hardware procurement, that was subject to a lot of customers deferring decisions, project delays, and so that growth was really coming from very low margin business, mostly in software licensing. So sometimes simply looking at top line growth isn't what really counts, particularly when companies see their earnings slip as a result.
But you have also found that while some of these companies, the listed ones, did deliver profits, they've done it by slashing their costs. That's not sustainable in the long term, is it?
Well, it's sustainable for several years, and I think the big trend that I looked at there, well, firstly, there were 2 things. One was the debt aversion from IT companies. A lot of these businesses, take UXC for instance, they had a terrific improvement in their profit. They had a net profit last year of $18 million. That was up 300% on the prior year. But 1/3 of their profit, $6 million contribution, came from cutting their net interest expense. They sold their field solutions business and cleaned up their balance sheet. Oakton's another company that did that. They took out $5.5 million in debt. And a few years ago, they were paying $2.75 million in interest costs. Last year it was only $400,000. This year they'll have an actual revenue contribution from interest that they receive. So that's one technique. The other key technique, though, which is more to the operations of these companies, is the way that they're flexing their workforce. And by that I mean they're hiring and firing much more quickly than they used to. SMS, Management and Technology, for instance, only finished the year with 7 more full-time equivalent employees than at the start of the year, at 1,682 members of staff. But during the year, they had up to 101 additional people in Q1. Period of peak demand, they then backed that off as demand fell away. So people being much more into short-term contracting in these companies. And the final trend very importantly, is outsourcing. And there, of course, we're seeing a lot of people now participating in that in this space, but none more so than Oakton, which over the last 5 years has increased the number of its people employed in India, in their facility in Hyderabad, gone from 100 to 187, while their Australian employment and their total employment has actually been declining. And that's all about lowering their cost base.
All right, Mark, we have seen the local IT numbers here also declining as a result of that offshoring. Let's talk telcos now. You say that the big three aside, there's been a lot of consolidation, and some of the growth in the smaller companies is because they're eating their dead. What do you mean by that?
It's a slightly graphic term, I guess, but what I'm talking about there is we saw some fantastic numbers from these third-tier telcos. Really, really solid, double-digit earnings growth in the last year. But the point that I was making is that a lot of it is being driven by acquisitions. So when you actually look at it from the industry perspective, well, that growth can be a little illusory, because really what we're talking about is a lot of businesses that are disappearing. So if you take iiNet, for example, in the last 2 years, it's acquired Westnet, NetSpace, AAPT Consumer, Transact and Internode. 5 significant companies in the last 2 years, they've gone. They've gone. It's no wonder that the iiNet numbers look terrific, because really that's a consolidation of 5 different companies.
All right, let's look at some of the bigger ones now. You say that Telstra and Optus, they've reported relatively flat revenue and earnings and NPAT over a period of time. But Vodafone, their network problems costing them, and you've questioned their long-term survival. What are you thinking there?
Well, they're just losing so much money. And as you can see, if you look at the half of the Vodafone Hutchison business that's listed here, which is the Hutchison piece, they've got accumulated losses of $3.1 billion. Now, when companies have been operating for, 10, 15 years, and they're still not making any money, they're losing money, their losses in the last reporting period were even greater than in the prior period. And of course, all of this goes back to the well-known fact that they had a lot of network issues, they had a lot of customer service problems, and Bill Morrow, who's now come in to try and turn this business around, really has a very hard piece of work ahead of him. But more importantly, in order to do this, they've got to throw even more money at this problem. So there's been a massive increase in their capital expenditure. We're seeing it go from around 15.5% of sales up to 22+%. It's the highest in the world. And this is for a company that's losing money. So the question that I'm asking is, how long before these international companies, that Vodafone and Hutchison, how long before they're really prepared to call it a day on that sort of loss?
All right, Mark, we do have to leave it there. It's a good question, and we didn't get time to talk about the NBN today, but I know you've noted that wireless connections are exceeding wired connections as well for the NBN. We'll leave that till next time. Thanks for coming on the show today, Mark. And Moira and Carson, I'll bring it back to you.
Thank you very much, our resident techie there, helping us out with the jargon in relation to that little cross.
The guru himself from Melbourne. We will take a very short break. At the close is next.